Welcome back to Investing Talk Podcast. Today, we're going to be looking at SHOP. You know it as Shopify, the e-commerce platform that's been really making waves lately. You guys sent us a really interesting mix of analysis reports, stock predictions, even some recent news. So let's unpack this and see if SHOP is a company you should think about adding to your portfolio.
Yeah, it's definitely been a hot stock.
You're telling me Shopify stock has practically doubled in the last 6 months. A 95% gain. That's nothing to sneeze at. When you see growth like that, what jumps out at you first?
I mean, that kind of surge, it definitely grabs your attention, right? It often signals strong investor confidence. But to really understand what's driving it, we need to look beyond just the stock price and into Shopify's performance metrics. One key indicator is their gross merchandise volume, or GMV.
GMV, for those of us who maybe aren't financial whizzes.
Right. It represents the total value of all the goods sold through the platform. Essentially, it's a measure of how much business is flowing through Shopify. And their GMV has been growing steadily, increasing by 24% in the third quarter of 2024.
It's a pretty healthy jump. Is that typical for them?
It's actually even more impressive than that. That marks the fifth consecutive quarter of over 20% growth in GMV. So we're seeing consistent, strong growth, which is a very positive sign.
Okay, so their sales are booming.
Mm-hmm.
But what about their actual earnings? I'm looking at a projection here that predicts Shopify will boost its adjusted earnings by a whopping 70% in fiscal year 2024 and another 19% the year after. Is that even realistic?
It's ambitious, but not entirely out of the realm of possibility for Shopify. You know they have a history of exceeding expectations. In the last 4 quarters, they've beaten EPS forecasts by an average of 25%.
Wow. So they're consistently outperforming predictions. That's great news for investors who got in early. But with a stock that's already seen such a huge run-up, the question becomes, is it too late to jump on the Shopify bandwagon?
Right, that's the million-dollar question. And it leads us to another important metric, the price-to-earnings ratio, or PE ratio. Shopify is currently sitting at 103 times forward 12-month earnings. That's high, even compared to other tech giants. The sector average is 26.1. And even Amazon, known for its premium valuation, is at 37.8.
So Shopify is significantly more expensive than its peers. Does that mean the ship has sailed for new investors?
Not necessarily. While the PE ratio is important, it doesn't tell the whole story. Another metric, the PEG ratio, which factors in future earnings growth, can provide a different perspective. Shopify's PEG ratio is at 2.4. Now, what's fascinating is that this actually represents a 90% discount compared to its recent highs.
So what you're saying is even though Shopify looks expensive on the surface, its potential for future growth could make it a good value.
Exactly. That PEG ratio suggests that despite the high valuation, Shopify could still be an attractive entry point for long-term investors. Of course, valuation is just one piece of the puzzle. We need to consider the whole picture. Their growth trajectory, market position, and the competitive landscape.
And speaking of things on the horizon, Shopify has their earnings report coming up on February 11th.
Right.
Are you keeping an eye on that?
Absolutely. Earnings reports always give us a valuable snapshot of a company's performance.
Okay, so circle that date on your calendars, everybody. But even before we get to February 11th, there are several factors driving Shopify's recent price movement, wouldn't you say?
Definitely. Their strong third-quarter performance, which we've already touched on, has contributed to a wave of positive sentiment among investors. But it's not just past performance. Future expectations are playing a role, too.
Oh, you mean like those analyst projections we saw?
Exactly. Some analysts believe SHOP's stock could reach as high as $140, which would be a 19% increase from its closing price on January 28th. So there's a lot of optimism baked into the current price.
Okay, so it seems like everyone's pretty excited about Shopify's future. But I'm curious, is this just hype? Or is Shopify really becoming the platform for businesses of all sizes? Our sources mentioned something about market share gains.
That's a great question, and it requires a balanced perspective. While Shopify is undoubtedly a major player in the e-commerce space, they aren't operating in a vacuum.
What do you mean?
Well, they're facing competition from giants like Amazon on one end, and then you have platforms like Wix and Squarespace catering to smaller businesses on the other. So while Shopify is carving out a strong niche, they're not without rivals.
Where does Shopify fit in this whole e-commerce ecosystem? What makes them unique?
They've positioned themselves as a comprehensive solution for businesses looking to build and manage their online presence. It's not just about setting up a website. They offer a suite of tools and services, from website design and payment processing to marketing and shipping solutions. Shopify wants to be a one-stop shop for entrepreneurs.
So they're like the Swiss Army knife of e-commerce.
Exactly. And this approach has resonated with many entrepreneurs, especially those looking to scale their businesses. Their focus on providing a comprehensive platform has helped them attract a wide range of businesses, contributing to those market share gains you mentioned.
All right, we've talked about fundamentals, growth, and market position. Now let's dive into the technical side of things. I'm seeing some interesting charts and numbers here. We've got 50-day and 200-day simple moving averages, or SMAs, and the RSI level. For those of us who aren't chart wizards, can you break down what all this technical mumbo-jumbo means?
Of course. Technical analysis can seem intimidating, but it's about using past price data to identify trends and potential trading opportunities. Let's start with the SMAs. The 50-day SMA is the average price of a stock over the past 50 days, and the 200-day SMA does the same over 200 days. They're basically trend indicators.
And what are they telling us about Shopify?
Right now, Shopify is trading above both its 50-day and 200-day SMAs. This is generally seen as a bullish signal. It suggests the stock has upward momentum and buyers are in control.
Okay, so the trend lines are looking good. What about this RSI thing? What's that all about?
The RSI, or Relative Strength Index, measures the magnitude of recent price changes to evaluate whether a stock is overbought or oversold. It fluctuates between 0 and 100.
So higher is better, right?
Not necessarily. Readings above 70 are considered overbought. Think of it like a rubber band stretched too tight. It might be due for a snapback. Readings below 30 are considered oversold, meaning the stock might be poised for a bounce.
Got it. So where does Shopify fall on that scale?
The 14-day RSI for Shopify is currently at 58.43. This suggests that the stock is neither overbought nor oversold. It's in a neutral zone, with room to move higher without raising immediate concerns.
Okay, so all the technical signs seem to be pointing in a positive direction. But I'm looking at a report here that has a hold recommendation for Shopify. Why would they recommend holding rather than buying, especially with all these positive indicators?
That's a good question, and it highlights the importance of considering multiple perspectives. Remember, technical analysis is just one tool in the toolbox. It focuses primarily on price trends and patterns. Those are valuable insights, but they don't tell the whole story.
Right. We also need to consider things like fundamentals and valuation, which we've touched upon earlier.
Exactly. In Shopify's case, their high valuation might be a factor contributing to the hold recommendation, even though their growth prospects look promising. Some analysts might be hesitant to issue a buy rating at the current price level.
So it's kind of a wait-and-see approach.
You could say that. It's a cautious stance that acknowledges both the positive momentum and the potential risks associated with that high valuation.
That makes sense. It's always about weighing those different factors and making informed decisions.
You know, as we've been discussing Shopify's performance and position in the market, I think it's important to kind of zoom out a bit and consider the broader e-commerce trends that could really impact the company's future.
Okay, I like where you're going with this. What are some of the big picture forces at play that Shopify needs to navigate?
Well, for starters, the global e-commerce market is still expanding rapidly. It's projected to reach trillions of dollars in the coming years, and this continued growth creates a tailwind for companies like Shopify that facilitate online transactions.
So even though competition is fierce, the overall pie is getting bigger.
Exactly. But it's not just about the size of the market, it's also about how consumers are shopping and how technology is shaping the e-commerce landscape. One trend that's been impossible to ignore is the rise of mobile commerce, or m-commerce.
You mean shopping on our phones?
Yes. People are using their smartphones and tablets for everything these days, and shopping is no exception. Platforms that don't offer a seamless mobile experience risk being left behind.
I know I do most of my shopping on my phone. It's just so convenient. Has Shopify adapted to this mobile-first world?
They've actually been very proactive. They've invested heavily in mobile optimization, ensuring their platform is user-friendly on all devices. They've also developed mobile apps that allow businesses to manage their stores and connect with customers on the go.
So they're not just riding the wave, they're trying to stay ahead of it. What other trends are you seeing that could impact Shopify's future?
Another significant trend is the rise of social commerce. People are discovering and buying products directly through social media platforms like Instagram, TikTok, and Facebook. It's blurring the lines between social media and e-commerce.
Social commerce. That sounds like a whole new game. Is Shopify playing in that arena?
Absolutely. They've integrated their platform with major social media channels, allowing businesses to seamlessly showcase and sell their products directly on those platforms. This opens up a whole new avenue for reaching potential customers.
Smart move. It seems like they're really trying to be everywhere their customers are. What other technological shifts should we be paying attention to?
Artificial intelligence, or AI, is becoming increasingly important in e-commerce. AI-powered tools can personalize product recommendations, automate customer service, and even optimize pricing strategies. Shopify is incorporating AI into its platform to help businesses improve efficiency and customer satisfaction.
AI and e-commerce. That's pretty wild. Sounds like the future of online shopping is getting pretty high-tech.
It is, and the companies that can effectively harness these technological advancements will be the ones that thrive. But it's not just about technology. Consumer preferences are changing in other ways, too. Sustainability is becoming a bigger and bigger factor in purchasing decisions.
You're right. People are thinking more about the environmental and social impact of their purchases. How is Shopify addressing this?
They're taking steps to reduce their carbon footprint, promote ethical sourcing, and partner with organizations that support sustainable business practices. They recognize that consumers, especially younger generations, care about these issues, and they're trying to position themselves as a company that aligns with those values.
So it's not just about profits, it's about purpose, too. Okay, we've covered a lot of ground here, from mobile and social commerce to AI and sustainability. What's the key takeaway for investors when it comes to these broader e-commerce trends?
I think the main takeaway is that e-commerce is a constantly evolving landscape. To succeed, companies need to be adaptable, embrace new technologies, and respond to changing consumer preferences. Right now, Shopify seems to be doing a good job of positioning itself for continued growth, but the landscape can shift quickly, so it's important to stay informed.
They can't rest on their laurels. But even with all these positive trends and Shopify's efforts to stay ahead of the curve, there are always challenges and risks to consider, right?
Absolutely. One of the biggest risks for any company in a fast-growing market is competition. The e-commerce space is crowded, with giants like Amazon on one end and a multitude of smaller players vying for market share on the other.
Right. We talked about competition earlier, but it's worth emphasizing. How is Shopify differentiating itself in such a competitive environment? What's their edge?
Their focus on empowering entrepreneurs and small businesses has been a key differentiator. They offer a wide range of tools and resources specifically designed to help these businesses succeed online. They want to be the platform that helps businesses of all sizes thrive in the digital world.
So they're not just providing a platform, they're building a community.
Exactly. They want to be seen as a partner, not just a vendor. And this approach has been a major driver of their growth. Small and medium-sized businesses often need more support and guidance. When it comes to navigating the complexities of e-commerce...
That makes sense. Okay, so competition is one risk factor. What other challenges should we be aware of?
Well, economic downturns can impact consumer spending, which could affect Shopify's revenue if people are buying less overall. That's going to show up in their numbers. And then there are regulatory changes that could create new hurdles for e-commerce businesses.
That's true. The regulatory landscape is always shifting, and that can create uncertainty for businesses.
Exactly. Shopify needs to be agile and adaptable to navigate these potential headwinds. They need to stay ahead of the curve in terms of technology, anticipate changes in consumer behavior, and be prepared to adjust their strategies as needed.
It sounds like they need to be constantly on their toes, anticipating what's next.
Yes. And that's the challenge and the excitement of investing in a company like Shopify. They're operating in a dynamic and evolving space, and there's always something new on the horizon.
All right, we've covered a lot of ground here. We've talked about Shopify's performance, their market position, and the broader trends shaping e-commerce. Let's shift gears a bit and talk about what all this means for you, the listener. What are some of the key takeaways you want investors to keep in mind?
I think it's crucial for investors to recognize that e-commerce is not just a trend. It's a fundamental shift in how we buy and sell goods and services. This shift is here to stay. And the companies that understand and embrace it will be the ones that thrive.
So it's about seeing the big picture and recognizing the transformative power of e-commerce.
Exactly. And Shopify is a prime example of a company that has capitalized on this transformation. But it's important to remember that no investment is without risk. The e-commerce landscape is dynamic and competitive, and companies need to constantly adapt to stay ahead.
Great points. So for those who might be considering investing in Shopify, what are some key questions they should be asking themselves?
They should consider the company's track record, their growth potential, their ability to adapt to changing trends, and the competitive landscape they operate in. Is the company's strategy sound? Are they making smart investments in technology and innovation? Are they effectively managing competition?
And of course, it's always wise to do your own research. Consult with financial advisors and make informed decisions based on your individual circumstances and risk tolerance.
Absolutely. Investing should never be a gamble. It's about making calculated decisions based on solid information and a clear understanding of your own financial goals and risk appetite.
Well said. Now let's circle back to some of the specific metrics and data points we discussed earlier. We talked about Shopify's impressive revenue growth, their expanding GMV, and their strong performance in key areas like mobile commerce and social commerce. What's your take on these numbers, and how do they inform your overall assessment of Shopify?
Those metrics paint a positive picture. They demonstrate that Shopify is executing its growth strategy and capturing a significant share of the e-commerce market. They're clearly doing a lot of things right.
Right. But we also need to consider valuation. Shopify's current valuation is high, but some argue that it's justified by their growth trajectory and future potential. What are your thoughts on this debate?
It's a tricky one. High growth often comes with a premium price tag. The key is to determine whether the company's future earnings potential justifies the current valuation. Are they going to grow into that valuation, or expectations getting ahead of reality?
So it's about looking beyond the current numbers
Yeah,
and making a judgment call about the future.
exactly. Investors need to assess whether the company's growth trajectory is sustainable and whether they believe the current valuation accurately reflects that potential. There's always a degree of uncertainty when it comes to predicting the future, but that's part of what makes investing both challenging and rewarding.
That's a great point. It's all about making informed decisions based on both the current reality and future expectations. Well, this has been an incredibly insightful discussion about Shopify and the wider world of e-commerce. I'm sure our listeners are now armed with a ton of information about Shopify. But before we wrap up, I want to revisit one of the sources you sent over, a technical analysis report. It breaks down Shopify's current trading patterns and offers a recommendation for investors.
Yeah, sounds good. Technical analysis can be a helpful tool, especially for those who are looking for potential trading opportunities.
Exactly. Now, this report highlights the fact that Shopify is currently trading above both its 50-day and 200-day simple moving averages, or SMAs. We talked about this earlier. But can you remind our listeners why this is generally seen as a positive sign?
Sure, moving averages help smooth out the daily fluctuations in a stock's price, giving us a clearer picture of the overall trend. When a stock is trading above its SMAs, it suggests that the trend is upward. Buyers are in control, and momentum is on the side of those who are bullish on the stock.
Okay, so that's a good sign for Shopify. The report also mentions the 14-day Relative Strength Index, or RSI, which is currently at 58.43. You mentioned earlier that this level suggests the stock is neither overbought nor oversold. Can you unpack that a bit further?
Of course, the RSI is a momentum oscillator that measures the magnitude of recent price changes. It's used to gauge whether a stock is potentially overbought or oversold. An RSI above 70 is often considered overbought, meaning the stock might be due for a pullback. Conversely, an RSI below 30 is often considered oversold, suggesting it might be poised for a bounce.
So Shopify with an RSI of 58.43 is right in the middle, a neutral zone.
Yes, it suggests that the stock has room to move higher, without raising immediate concerns about being overextended.
Okay, so all of this sounds pretty encouraging. Here's where it gets interesting. Despite all these positive technical indicators, this report ultimately gives Shopify a hold rating. Why wouldn't they recommend buying if the technicals look so good?
That's a great question, and it underscores a crucial point. Technical analysis is just one piece of the puzzle. It's a tool that helps us understand price trends and momentum, but it doesn't capture everything.
We need to consider the bigger picture.
Exactly. We can't ignore fundamentals, valuation, and overall market conditions. In Shopify's case, their valuation is high, as we discussed earlier. While their growth prospects might justify that premium, in the eyes of some investors, others might be hesitant to jump in at the current price.
So the hold rating is a cautious approach that takes into account both the positive technical indicators and the potential risks associated with Shopify's valuation.
That's a good way to put it. It's saying, hey, this stock looks promising from a technical standpoint, but let's see how things play out, especially given its high valuation.
Okay, so it's a balanced perspective, weighing both the potential rewards and the risks. What advice would you give to investors who are trying to make sense of all this information?
I think the key is to stay informed and monitor the situation closely. Pay attention to Shopify's upcoming earnings reports. Track how the stock responds to news and events, and keep an eye on the broader market environment.
Investing is an ongoing process, not a one-time decision.
Absolutely. It's about staying engaged,
Mhm.
doing your research, and being prepared to adjust your strategy as needed.
Well, I think we've covered just about everything there is to know about Shopify, at least for today. We've explored their impressive growth, their position in the competitive e-commerce landscape, and even delved into the technical side of things. Hopefully, our listeners now have a solid foundation for making their own informed investment decisions.
I agree. It's been a great discussion.
And remember, as always, we encourage you to do your own research and consult with a financial advisor before making any investment decisions. What are your thoughts on Shopify? Share your insights in the comments below. Subscribe to Investing Talk Podcast for more deep dives into the world of investing. And don't forget to share this episode with your friends.
Thanks for listening. We'll see you next time.